Okay, so everybody understands traditional, you can only use the tax depreciation that comes from the contributed asset. Traditional with curative says, well, and I didn't know this, the way it was couched in grad school, and I think it might have been Pfeiffer who was taking a partnership class. The way I learned this rule was that if you added an additional piece of depreciation, depreciable property, you could cure the shortfall. So if we go back to the balance sheet, and if we had no depreciation available based on the asset that existed at the date we formed the partnership, if we went out and bought another widget machine for $1 million, then we would be able to use that $1 million newly acquired machine to allocate allocate depreciation to Jeff to cure the shortfall that existed on the asset that was contributed. So in this case, how much is the shortfall? Kelsey, who do you want to call in?
Brett.
Who?
Brett.
Brett, how much is my shortfall? How much did the ceiling rule?
100,000.
100,000. So we have a shortfall of 100,000, correct? So if we added another machine, and let's call it for $500,000 in a straight line for 5 years, how much tax depreciation do we have due to the newly added machine?
100.
100. What do we owe Jeff?
100.
So Jeff would be able to harvest the depreciation off the newly acquired machine in order to cure that shortfall.
So if it was in for $1 million, the first 100 would go to Jeff, and then it's 50-50 for the rest.
Yeah. That's a very, very good question. So let's do that again. Did everybody understand Brett's question? Okay. And why would that be the conclusion?
Because you have your required piece, then you have your agreed upon for the rest.
That's right. That's 100% right.
What if they bought like a building for 39 years? How would that shake itself out?
You mean in terms of?
Yeah, say we're doing the second method with remedial, and then we buy a $1 million building, for example.
Oh, well, it doesn't have to be the same kind of asset. So if the shortfall, let's say, let me rephrase articulate what I think your question is. If instead of a widget machine, we had a building that was fully depreciated, and then we added a machine that created depreciation, is that where you're going?
I was thinking like if we did the machine still, did a building, is the runoff over 5 years or would that get cured over 39 years?
It'd be over the 5 years. But the building depreciation probably is enough to harvest that out, harvest a portion of that tax depreciation out to cure that 5-year problem, would be my instinct. So traditional with curative says that I have the opportunity to cure by addition of depreciable property. That's the way I learned it in grad school. Or that was my impression of it. But when Fife went through, he said you had to pick a specific item of deduction and allocate that specific item of deduction, and you had to stick with that specific item of deduction. Is that right? Probably. I mean, Pfeiffer's generally pretty good at paying attention to what the hell's going on.
What do you mean by that? Specific item.
So I could say, well, I'm going to specially allocate my rent expense to cure the depreciation shortfall. That it's going to be rent expense every year that I have to dip into to cure the depreciation shortfall. Or I could choose some item. That's what Pfeiffer said.
Does that have to be the same character?
One would think, but I don't know the answer to that. I'd be surprised if that weren't the case.
And that's once you would decide that you have to use that specific expense until it's cured.
Yeah. Well, for over the 5 years. So if that specific expense came up short in a given year, you're going to bump into the ceiling rule.
Hmm. You can't flip it though. Like first year you want to do rent expense, next year you can't flip it to something.
That was not my impression from the discussion with Fife, so I'm going to stick with my grad school understanding and stick with depreciable property, because that always made sense to me, because it was of the exact same expense type, and that made sense to me since it was the exact same expense type. The addition of depreciable property using that exact expense type would cure the shortfall. That always made sense to me. This concept of using some other item of deduction didn't really make sense to me. But again, I mean, he had it. We were sitting in the conference room. He was going through Golden Gate. Okay. So let's talk about there were 3 options. Kelsey, what were they?
Traditional with curative, and remedial.
Remedial. Okay. Remedial is a free-for-all. It's the wild, wild west. We can just make up whatever we want to make the capital accounts get to the right spot. So if this is our fact pattern, where Jeff contributed cash of $1 million, Pete contributed a machine of $100,000 with a cum of $100,000, and this is the exact same fact pattern. So, Brett, we have with traditional, we have a ceiling problem, correct?
Correct.
With traditional, with curative, we have a ceiling problem until we add a new machine, and we still possibly have a ceiling problem, correct?
Correct.
Okay. The remedial says, well, wait a minute. This is the wild, wild west. We're going to make the allocation, we're going to do allocations to make the capital accounts drive to 0 at the end. So it's the same steps as we had before until you get to the allocation. So, Brett, what is my fair value depreciation?
200,000.
And allocated to Pete and Jeff and
100.
100 each. So how much depreciation do we owe Jeff?
Fair value?
Yep.
100.
How much tax depreciation do we owe him?
0.
No. How much do we owe him? Just
Oh.
What is the guidepost?
Yeah.
Let me be more precise in my question. Using book depreciation as a guidepost, how much tax depreciation do we owe him?
100.
100. So the remedial method says, we don't care. We don't care if there's any sort of depreciation to support that. Jeff, Jeff is going to get his 100 depreciation. No matter what. So let's put this in the most stark of fact patterns. Jeff is owed 100 of depreciation. We're going to give him 100 of depreciation. And I'm going to pretend that we have no income, and this is not the way this works, but this is going to drive the point home. We have no income, and we have no expenses for 5 years. We don't collect $1, we don't spend $1. Everybody agreed on what our fact pattern is? So the remedial method says, well, if we have no income and no expenses, what's our book income and what's our taxable income that's going to be reported on the 1065, Brett?
0.
0. Well, we're saying that we're giving Jeff a K1 with a $100,000 deduction, are we not?
Yes.
So right now, I got a K1 that says $100,000 loss, correct?
Yes.
But I have no taxable income at all. What do you think the offsetting action would be? Would it be to jam Pete with $100,000 of income? So Pete's going to get a K1 with $100,000 of income on it. Jeff's going to get a K1 with $100,000 of expense, and those two are going to zero out because 100 of income to Pete, 100 of expense to Jeff is 0. That's exactly under my very bad fact pattern, fictitious fact pattern of no dollars of income, no dollars of expenses. Gets us back to 0. And what does that allocation do, Brett? Do we accomplish what 704B and 704C try to do in pushing the inherent gain to the proper party and equalizing the capital accounts? Does it do that?
Yeah.
It does. So the remedial method is a free-for-all.
It doesn't matter what type of expense you're allocating, as long as you get to the right answer in the end.
It can be rent, it can be depreciation, it can be whatever you want.
As long
Or,
as it's a $100,000 loss in this case.
or in the inverse, okay, so there's a push and a pull, or a different way of looking at this. Let's pretend for 1 second that we just had $100,000 of income on an annual basis. If we said the $100,000 of income gets specially allocated to Pete and the 0 to Jeff, does that cure the problem?
No.
It does.
What?
Well, Jeff's going to have we're both going to have $100,000 on, I think it does. The point is, and I think you might be right, I think I might have a math problem on that. My point is, it can be an item of income can be shoved to the inherent gain partner, or an item of expense can be pushed to the non-inherent gain partner to equalize capital accounts. So it could be an allocation of either to make that true. Now, I think you busted me on a math problem, maybe, because I don't know that it does equalize if I have 100 of income. Well,
Yeah, if you have 100 income, you're shoving it all to Pete, then Jeff still has 0 loss.
yeah, they don't equalize. So I think I do have a math problem. But I know it can be either. I'm just going to stop there because I know I'm on shaky ground. Okay?
Which one do you see most common?
Well, what do you mean, what do you see most common?
The method, because that's what you
Oh.
used yesterday, right? The remedial. Is that what that was?
Well, let's go back to if I don't want to go here yet. I'm going to answer that question differently.
Is there something in the partnership agreement that says which one they have to use?
Can. Certainly can. But that is generally going to be, you have to have somebody that has recognition that you want that in there for a specific reason. The more common is the partnership agreement is going to say 704C allocations are going to be dictated by the managing member of the partnership. That's more likely the language that's going to be in the partnership agreement. But, so I'm going to change this from, what if Jeff contributed $2 million in cash, and Pete's widget machine was worth $1 million, and we're still 50-50. Okay, so my equity section is how much from a fair value perspective, Stuthman?
3.
No, both were 50-50.
Oh. 4.
Okay? So Jeff's contributing us $2 million in cash. Okay? But the machine is still worth $1 million. Are we in balance on the 704B side?
No.
Okay? What do you suppose we're missing to get into balance? If my machine is worth $1 million and I'm getting $2 million of equity, what do you suppose I'm missing?
Goodwill.
Goodwill. Okay, so if we say that there's a goodwill component. Wait a minute, there we go. We have goodwill, 0, that's $1 million. Oops. Are we now in balance?
Yes.
Okay. So the remedial method, traditional has a ceiling rule, correct?
Correct.
Traditional with curative has an allowance for an adjustment to the tax depreciation for additional assets added, correct?
Correct.
Remedial I described as the
Wild West.
Wild West free-for-all. So if let me ask this question, Brad. If we were dealing with not a partnership concept and you bought goodwill and there's $1.5 million of acquisition cost associated with that goodwill, what's my annual write-off?
100,000.
100,000. So you would get $100,000 a year. Now let's take that to the next step to say that if we have $1 million of goodwill and we acquired that for 704B purposes, how much depreciation, and I should change it to $1.5 million for purposes of our example, how much 704B depreciation is available?
If it was $1.5 million, it'd be 100,000.
100,000. So if Jeff and Pete were 50-50 partners, Jeff would have how much 704B goodwill amortization?
75.
50, right? It was 100,000.
Oh yeah. Yep.
Okay. So now we're in the wild, wild west. It's a free-for-all. Going back to our original rule, and we highlighted this on a page earlier that said goodwill fell most likely into that third bucket. What was 3 types of assets, Noodles?
Was short-term, recognizable, depreciable assets and things that we will sell in the future.
And goodwill feels like something that falls in the self-created goodwill falls into the bucket of something that feels like we should be recognizing a gain only when it's sold in the future.
Yeah.
Under the remedial method, self-created goodwill, we have this $50 that's associated with that goodwill amortization that's due to Jeff. The remedial method says that came in at fair value. The remedial method says this is the wild, wild west. Jeff is owed that $50 of goodwill amortization. So, do you remember earlier I said if you're the inherent gain partner, you don't want the remedial method.
Correct.
As the non-inherent gain partner, you want the remedial method. Because I, as the non-inherent gain partner, want my $50 of depreciation or amortization. As the non-inherent or the inherent gain partner, I don't want $50 of income jammed my way. Because if we sell the goodwill in the future, what's the character of that gain, Brad?
Capital.
Capital. If we have the remedial allocation that's going to jam $50 of income my way, what's the character of that gain?
Ordinary.
Ordinary. So there's 2 really bad things that just happened is non-inherent gain partner. One is, what's character?
Ordinary.
Ordinary. And when did it happen to me?
Right now.
Right now. And if we don't have remedial turned on, when is it inflicted on me?
Whenever you sell.
Whenever we sell it. So if I'm representing somebody that is getting into a partnership and there's this goodwill bucket that exists and they're the inherent gain partner, what am I trying to insist on in the partnership agreement?
Traditional.
Traditional, or traditional with curative, don't care. But traditional is most likely. If I'm the non-inherent gain partner, representing the non-inherent gain partner, what do I want?
Remedial.
Remedial. So going back to the page when I said, you know, it's that third bucket, goodwill falls into that third bucket of it's only going to be recognized when it's sold. And then I said, except we need to talk about the remedial method. This is why. So you want to make sure that you don't have the remedial method if you have goodwill in play. Because it's the wild, wild west. You can do whatever the hell you want.
So goodwill, even though we're getting a deduction like first year, because it's amortized over 15 years, we don't cure it or do anything with that if it's traditional, right?
Correct.
Okay.
Yeah, and
So I guess like my thought is it feels like the second category, it's like getting
Depreciable.
you know what? I've never thought about that.
You know,
Because I've always, in my mind, once I turned off remedial, I've left that in the exact same category as land, in my mind. But what you said and what you just picked up on was the conversation Brett and I had a little bit ago when we bumped into the ceiling earlier. If we didn't have any allocation, then we get to the end and I have no value left under 704B, and therefore it's going to go under the agreed upon. I've never viewed it that way, and maybe I should have, because I'm saying for 704B purposes, that probably does have a deduction associated with it, which is not available, which bumps into a ceiling, which means that the goodwill should be allocated based on agreed upon versus required. But I've always treated goodwill as required. I don't know if that's the right answer, because I've never even thought about that before. Does anybody have any questions on that?
If you're the inherent game partner, this says inherent game partner does not want remedial. Is that only if it's goodwill or is it all the time?
That's a good question. What do you think?
That's what I'm asking.
What do you think, though? What's your instinct?
I want to say all the time
That you want what?
that you don't want remedial if you're the inherent game partner.
That's exactly right. But you sure don't want it with goodwill. So Sam's question, which in my view is a next level question, is that, wait a minute, you just made the point on goodwill and not wanting to be harmed by that deduction from goodwill. Why isn't that true for all depreciable property? Why wouldn't you want, as the inherent gain partner, to always be in the category of traditional method? And I think you do. I mean, because if you bump into a ceiling rule, that's a good thing for the inherent gain partner. Bad for the non-inherent gain partner.
Aren't you gonna give Brad a coupon over there
Do
for
what?
his comment?
What? Huh?
Stoothman's comment that you said you'd never even thought of before? He
That's
doesn't get it.
depreciable.
Okay, all right. Here you go, Brad.
I mean, he gave it to a guy for picking up pigeons.
I did actually. He fucking deserves it. You guys know about this?
He's picking up dead pigeons.
You know
I
about
don't
this,
know.
right? This Wyatt from CAS here?
Oh yeah.
White's in healthcare.
Healthcare. Healthcare? Okay.
During, when he interned, or maybe his first year, I remember he was picking up dead birds on the.
He did it yesterday. He's still picking up dead birds out there.
He walks in, he grabs a trash bag, and he grabs some paper towels, and I don't know how Hoffman figured it out, but you figured out he was going outside to pick up dead birds.
It's like, what are you doing?
He's the designated dead bird upper.
Yeah.
Oh, went outside and they just banging y'all's building?
Yeah, on the windows.
And I'm like,
The cleaners are so good.
But when he said he's going out to get a pigeon, I said, well, here's a gift card for your services. And I still think the guy's getting screwed.
I want to pay you for this. Here's a gift card.
100%. And I don't think we're doing enough. I mean, Wyatt needs something for the pigeon pickup services here that he's providing.
It's all figured in, Pete.
I'm sure it is.
I told him to put it on his self-evo. That's one of his accomplishments.
I'm 100% on board. If that kid is dedicated enough that he's going to go out and pick up the dead birds, I think that is.
Do we not pay for a cleaner?
Right. That's what I said.
They don't pick them up.
So our veranda has carcasses if Wyatt doesn't do the job.
Yeah, there's some I feel like tax season. Sometimes they lay out there for a few days. And we just keep them.
You know, this conversation, I didn't know I was going to have this when I got up this morning. That's for sure. The dead bird conversation.
Well, it's really scary when you're working and one of them bangs against the wall and you're like, oh my gosh, like what just happened? Bangs against the window.
Yeah, I don't know what broke that window. So
Okay,
someone
but
thinks it's the building. No, it was not.
Brett and
someone-
Trent were the only people in the office when the window broke that night.
It's true.
That's
What
But
what
it's happened. We have no clue. Trent and I were sitting there, and all of a sudden there was just a loud crash, and we looked over, and the window was shattered.
I don't believe a word of this.
It's exactly what happened.
Okay, so this is.
It was during opening night of NFL last year.
I'm sure a football was being thrown somehow.
It was not.
There was, So, Christmas Eve, I was in the Omaha office, and you know the story, I think, don't you? And for whatever reason, I was going from my office to the mailroom, and I don't know why I was being stupid, but I was going through, and I was just taking the cube doors and just closing them as I went. And I have no idea why the hell I was doing it. None. I was thinking about God only knows. And I'm walking past. You have Jeff Snyder's old office, and you have that row of cubes that are there, and then there's a super cube row of cubes. And I go through and I close the door, and I'm taking steps, and there's a thud. And I turn around, and the door had come off the cube and was falling over. So I'm like, fuck. So I turn around and I try to catch said door. I don't get there, and it hits the cube and just shatters. Nobody's there. So now I'm in this conundrum of, do I raise my hand and say I'm the idiot that broke this door, or do I pin it on the cleaning people? These are my options.
Sounds like ethics training.
So
Are we getting credit for it?
yeah, no shit. So I called David Horner, which most of you probably don't know who David is. And
I do.
this is the freakiest thing. I said, David, I have a confession. Swear to God this happened. This is no shit. He goes, did you break a cube door? What? How the fuck do you know that? Why would that be your guess? And I go, I did. You can take it on my comp at the end of the year. But how he guessed that? This was an hour after I did it, on the way home on my cell phone. How he guessed that, how he knew that, if there's cameras in the office that we don't know about, that was so super weird to me, I didn't know what to do with it. But no, I called and owned up to it.
He didn't tell you why he guessed that? That is like a very random thing for him to just assume.
With no reason.
That's because he did it. Once. He probably did it once.
He probably slid that one slightly off the rail, and then you just finished it off.
You know how much that door cost?
Wasn't it something like $1,000?
$1,500. Motherfucker.
Did they take it out of your paycheck?
I don't know. If they did, how does one know?
I would know.
Well, I mean, if
Would you not know?
Yeah.
Be like, where's my money?
No, he's saying they took it out as like year-end comp.
yeah, year end. Yeah, if it went on my weekly, I'd notice that. Well, I don't think I would notice that. My wife would notice it, but I would not notice that. I am blissfully unaware of lots of things. Let's see. That's not what I wanted. Okay, so this is that deal we did. I had the call about yesterday that shows, let's go to 704C first, that my beginning tax basis was negative 20 million. It ended at 15 million. And then I have the 3 buckets of assets that I had to deal with. One bucket is the short term. In the short term assets shows I had inventory for the hogs that the inventory was turning in year one, and there was a $16 million or $17 million inherent gain that existed with respect to those hogs. Those hogs are sold in year one, and the first partner ended up getting a $13 million will get a $13 million special allocation of that income because that short-term asset was sold in year one. The second bucket was depreciation. And Kelsey, where do you start for who gets what depreciation?
704B.
704B. So you go to the 704B account. My depreciation was 62 million, or the population of fair value was 62 million based on the underlying assets. Those assets were being depreciated over 10 years because this is specialty farm equipment. And since the majority of the assets were specialty farm, I took the amount over 10 years, which said that the non-inherent gain partner that contributed 15 million is owed 3 million. You know, Joyce, who also contributed $1 million, gets their 62,000. I have cash contributors, and I go to my 704C account, and I've got only 2.4 million of depreciation that's available. If I was using the traditional method, would I bump into a ceiling, Brett? If I was using traditional with curative, I can add assets later, which would have worked, by the way, because a minute after the formation of this, they bought a target for $100 million. So there would have been a lot of assets. So traditional with curative actually would have worked. But they said, we're doing remedial. So the non-inherent gain partners got their 3 million, their 62, so on and so forth, and which results in an income pickup of $1 million to that particular partner. So how the hell does this work? Let's do this for a second.
I have a question real quick.
Yeah.
If like, for some reason like half of those hogs die or something, like, do they just standard in this case get like all the deduction for that since they've picked up the income related to that? Or
Well,
if
they
like
only pick it up when the hogs are sold. So the question is, and I got to figure this answer out sooner or later, is that if I sell for something less than 704B basis, what impact does that have on my 704C capital account? So I have $16 million of inherent gain sitting in there, correct? So if I sold the asset, I'm going to say that I have zero basis in that asset for purposes of discussion. Okay, so if I sell it for 16 million, 12.7 would go to this particular partner. Now what happens if I sell it for 10 million? Now my 704B capital, or my basis, was 16 million, correct? Now I have a loss for 704B of $5 million. But I still have an inherent gain of $10 million because proceeds for 704C was 10 million, correct? My basis was 0. I got a loss in my 704B account of 5 million, 2.5 to each partner, however that worked. But I got a $10 million gain. How does that work? And I don't know the answer to that. I should know the answer to that, but I don't. Because everything appreciates, Brad. Okay? So, how does this work? You're confronted with, and maybe we go back to the other example. What's the best way to frame this? I might have to just come up with a different fact pattern. Okay, so I'm going to say I have book income of $100,000 or $1 million. I have book depreciation of $200,000. I have book gross income. I have book net income of 800. Sam, when we're doing an M1 schedule, what number do we start with as our beginning number? Book income. Okay. So let's go back to this, and let's say that my net book value is 500,000. Which means that if that's the case, let's do some undos here. Does that give me the right spot? Nope. Does that give me the right spot? I think it does. 2 million, 2 million. 0. Because this is saying this is negative 500, right? Why didn't that work? Oh, it works, right? We have $100,000. $100,000 is due to Jeff, correct? And we have $200,000 that's due to for fair value. Oh, this accidentally works. Okay. So we have $1 million of income, correct? We have $200,000 of depreciation. Okay. And our only M1. Sam, is depreciation. How much book depreciation, well, let's do it both. How much book depreciation is embedded in my net income number?
200.
Okay, so do I add that back or subtract it?
Wait.
No, to get to arrive at taxable income for M1.
Oh, well, yeah, add that. Well, why all of it?
Because now we're going to deduct tax depreciation, are we not?
Oh, you just breaking it out into two.
And I'm doing it for a specific reason. Okay? How much is my tax depreciation? Okay? It's 100. Taxable income is how much?
99.
So how do we execute on this special allocation? Is the question. And this is how I do it. And this doesn't make it right, but this just makes it how I do it. We had 3 categories of assets, right? Noodles, what were they?
They were short-term recognizable, depreciable assets and things we'll sell in the future.
Okay, and so I'm going to push that aside for a second. If we have an item of income that occurs post-formation, or we have appreciation that occurs post-formation, that goes agreed upon, right?
Yes.
Okay, so now, as an M1 schedule, you have to ask yourself, what is agreed upon and what is special in terms of how you have to confront this. Okay? So, this is Pete and Jeff, right? Is that who this is? Yep, Pete and Jeff. So now, I'm going to break this up into something that has occurred post and something that's required because it was inherent gain. So do Pete and Jeff enjoy, should they equally share in the net income of the operations? They should. So from a book income perspective, Pete and Jeff should have $400,000 of book income, shouldn't they? So this depreciation, this GAAP depreciation, this fair value depreciation, and they're not going to be the same. They just happen to be in this case. So let's be clear about that. The GAAP depreciation, is that something that occurs post Pete and Jeff getting together? Yes or no? Yes. Yes. Okay, so we're going to add that back to Pete and Jeff. So 100 and 100. GAAP depreciation. Okay, so we know our tax depreciation is 100. And we've done our analysis as to who that depreciation should go to, haven't we? And who does it go to?
Jeff.
Jeff. How much goes to Pete? So taxable income to Pete is 500, and Jeff is 400. We have taxable income globally of 900, and by virtue of segregating the M1s, or each item in the M1 schedule, by, is this something that occurs post us getting together? Therefore, the M1 is going to be allocated on the agreed upon amounts. What is what's a required allocation, and driving the M1 based on the agreed upon allocation is going to drive your analysis of Pete's K1 and Jeff's K1.
So would this look any different if the 704B and the GAAP depreciation didn't equal each other?
Yeah, well, let's do that. I'm completely okay with that. Because Leslie's saying, well, what if this is 300, right? And that's fair value. Now we have a disconnect. Well, in order to derive at taxable income, you're going to key off GAAP. The fair value piece is only there to serve as a guidepost as to what the non-inherent gain partner is getting in terms of depreciation. There is no correlation to GAAP. It just happened to be equal in this case. So now my 700, right? 350. 350. Now I got, 150. 150. And we have the same result. So it's going to be, the gap is going to be allocated or backed out in proportion to everybody's ownership. Okay, so this piece of how do we take that special allocation and run it through the M1 schedule, my procedure, for lack of a better description, is start with global. What is this is just your global M1 schedule. This is no different than the M1 schedule you're going to do for an S Corp, partnership, C Corp, whoever. This is exactly the same. Then, and the reason I broke this out between GAAP depreciation and tax depreciation is I'm smart enough to know that some of these items are going to be split based on agreed upon, and some are going to be split based on required. And now I have to break this apart, this M1 apart, to say, well, is it agreed upon? If it is, it's going to be agreed upon in the K1 allocation. If it's a special allocation, then it's got to go to the right person. Okay, so when we're going to be utilizing this, there's going to be an M1 that says there's a $16 million add back globally that's going to occur. My market hogs are going to sell for 16, there's no gain or loss for GAAP purposes. So over here, there is no M1 for GAAP on that. But there's going to be a $16 million add back with respect to those market hogs to get to a global taxable income. And then I gotta be smart to say, well, of that 16 million add back, none of that add back is going to go to the cash contributing partners. And 12.7 million is going to go to the non-contributing or the inherent gain. 408 is going to go to the inherent gain. 727, 686, so on and so forth across. So globally, I'm going to have the $17 million M1, and that $17 million M1 has to then be broken out by K1, by partner, to figure out who has that special allocation of income. Any questions about that? And that takes practice.
So you were representing Standard Nutrition in that example, right?
Yes.
We are,
Yes.
and they're the inherent gain.
The
Or
biggest
yeah.
one.
Yeah.
Yep, they have a fair value capital account of 40, negative of 20, $60 million of inherent gain that they're sitting on.
But we use the remedial method,
Mm-hmm.
and that's not necessarily a good answer for them, right? Is that what
Well-
we decided? Or were they just doing that in order to, kind of push the deal through?
Bingo.
Okay.
Bingo. The other side is taking the position, I'm coming with 50 million of
Yeah.
money.
Yep.
And you want to shortcut me on my depreciation?
Yep.
We don't think so.
Makes sense.
And Standard basically said, we see the value in this deal, and we're going to take the income hit because there's value locked up in what we have. There's value, somebody is willing to sell us their business line, which is exactly like our business line. So we're going to double in size by virtue of you coming on and giving us the cash. We're going to double in size by virtue of acquisition. And, oh, by the way, the seller is so tired of being in this business that they're going to give us a $30 million discount on the business. So if I just break this thing up and sell it in pieces, instead of $100 million of acquisition cost, if I break it up into pieces immediately, I got $30 million of value that's going to pop. So this income allocation is just noise in the larger, broader, big picture. But if you are, and they agreed to it right up front. There's no doubt from the other side, that's the way this was going to shake out. And Standard was very amenable because we want to get this deal done.
Yep.
When would that close? Did it close finally? All right, whatever. Nope. I want to close this too, right? Nope. See, I wrote this page and I got lazy and I figured we'd just do this in class. Okay, so are there any questions on that whatsoever?
I got a couple.
Yeah, go ahead.
So going back to the short-term bucket,
Okay?
if you have AR and AP,
Yep.
are you going to specifically look at those buckets inside the AR and AP when they're brought to the table, or is it just going to be the first AR collected for the?
So let me see if I'm answering your question.
Okay.
We have two items of AR.
Mhm.
I'm AR. You have an AR from Pete, and you have an AR from Kelsey.
Yeah.
Are you going to go into the AR to figure out whether you've truly collected both Pete and Kelsey, or are you just going to say they were collected?
Yeah, or if say those are equal to 100,000, and throughout the activity for the year you collected 200, are you just gonna say their 100 was collected, or you need to go specifically find out if those two accounts were?
I've never gone and specifically found out. The question I actually have though is embedded in that 100, is there anything that's bad? If there's anything that's bad, I might go as far as to say, well, Kelsey's a slouch. She's not going to pay her bill. So I might specifically identify something that's not going to turn and keep my eye on that. But in general, it's going to be all 100 turns. You gave me a value. AR is generally collected somewhere between 30 and 90 days. And that 30 to 90 days is going to be a quick turn. And unless I have something in that AR pool that I think is uncollectible and not going to be good, then I'm just going to deem it all to be, I'm not going to go into specific collection. Not going to do it. Okay? And same on AP. I'm going to deem it all to be paid. Okay? Any other questions?
Yeah.
Okay?
So we're doing this from the onset from a new partnership perspective.
Yep.
Or what if, or how is it handled when an existing partnership comes to Lutz? We look at their capital accounts and say, or do we look at their capital accounts typically and say, this is not in proportion to your ownership percentage? What's going on here? Should we be looking for, maybe there's a 704C problem that,
We should. It's difficult. Not all practitioners are created equal. And I would say that the level of recognition over the past 2 days or day and a half or whatever we have might be something more than 0 in this room. And 2 days ago, I'm not sure that you would have been able to formulate that question, maybe. So not all practitioners are going to have a 704B capital account, and a 704C capital account, and a 704B balance sheet that is quantified the inherent gain. So getting this from another practitioner can be a challenge. So there are times, and there are times where we know there's a bust, and we know there's an issue, and we say, okay, this does not look right. We're not in proportion. We're not sure what special allocation should exist. And either we hold this as a constant or we start curing it. What do you want to do, client? One of the two. You got two choices.
and that's only easier to diagnose if you know the same partners have been there from day one. Because if partners have come in and out, then there could be some.
More mud in the water. 100%. 100%. Okay, so I didn't bring this up. Do you have any more questions?
That was it.
Okay, because now you made me and this should be in here. I think I was silly not to bring it up. Okay. We're going to be talking about, we've been talking about 704C, right? So far. This is called a reverse 704C. Because what we've been talking about so far is you have people that are contributing assets to a partnership. Now we got to measure the inherent gain to the partnership. What do we do? And Joe brought this up yesterday, but he didn't say these words, reverse 704C. He was talking about Heritage, and Heritage has these communities, and these communities get rolled up into the mothership, and every time it gets rolled up into the mothership, they do this shortcut calculation to try to make all make sure everything's going to equalize out. Do you remember him saying that? Okay, this, what he was saying without saying it, was this is reverse 704C, is what this is. So, and I'm going to just stick with whatever my balance sheet and the spreadsheet was. Okay, I'm going to say that we get to year 5, and in year 5, Oh, you son of a bitch. In year 5, we actually now have negative million. Okay? And we have 0 basis for 704B because we've run it out. We've done all the special allocations. And that Pete's capital account is I'm going to just say it's 500,000. Jeff's is 500,000. And that's not specifically right for what our fact pattern completely was, but at this point, there's no inherent gain because we've run out the schedule. Okay? So everybody on board with what we have so far. So we have cash of $1 million, correct? We have a widget machine. 1 million, a cum, 1 million, asset side 1 million, liabilities 0, Pete and Jeff in the equity section is 500 and 500. Okay, that's what we have up there. The reverse 704C says, well, Leslie believes in our enterprise. We believe in Leslie. Leslie contributes $1 million to the entity in exchange for a 1/3 interest. Okay? So, how much does my cash go up to by virtue of the contribution? $2 million, correct? So, what's my accounting equation, Sam?
Assets equal liabilities plus equity.
Okay, and where do we always start?
Equity.
Equity. By virtue of her putting in her $1 million, what's my equity section?
2 million.
There's 3 of us.
500, 500, 100.
How do you feel about this?
Wouldn't it be the 2 million though? Cause you got, yeah, 2 million.
Okay, so let's talk about this. Okay, because I'm being dumb, thinking you're dumb, because I haven't said the words out loud yet. I'm like, why isn't she making this connection? That's the way. Okay, so you infer value. So if she puts in $1 million for 1/3 interest, how much value do Pete and Jeff have? She has 1/3 for $1 million, and there's 3 of us. 3 million. Okay, so the word I should have been introducing, and I did a poor job, and I called you stupid, but that was not appropriate. I mean, I really didn't mean that.
It's fine.
Okay, you get my point. That was not appropriate. That sounded a little too sincere from my side, but it wasn't. Okay, is that when you have the $1 million being contributed to the entity for 1/3 interest, you get to revalue or restate what your equity section is. Okay, so if Leslie contributes $1 million for 1/3 interest, that would infer the other 2 interests that are equal in terms of proportion are worth $1 million each. So my equity section is how much?
3 million.
3 million. So I have Leslie, I have 1 million, 1 million, and 1 million for a total of 3. How much liabilities do I have, Sam? 0. So my total assets, or my total liabilities plus equity is 3 million. So what does my asset side have to look like? 3. Okay? How much cash do I have? 2 million. Okay? So now the fair value goes where? Let's say it's still all equipment. It could be goodwill. Somebody's gonna have to give you that number. So the fair value of my equipment is $1 million based on this. So now, even though on day 1 we had this fact pattern where Pete came with asset with $500,000 of basis, Jeff got all the depreciation, that equalized capital accounts out, correct? Right? Leslie comes into the partnership, 3 years later, contributes $1 million. The partnership issues, if Jeff has 3 units, I have 3 units, we issue Leslie 3 units in exchange for $1 million. We now have an event that revalues the entity. And so, we have an event that revalues the entity. We have a new 704 event. So the issuance of units in formation is a 704 event where you have to go through our steps. What are our steps?
Create a 704B, C, an inherent gain balance sheet.
Okay, and then you have to categorize the assets into 3 assets, and then you have to do depreciation. By virtue of us having new partner enter into the partnership, we have a revaluation event to say our equity section was $1 million. It's being revalued to $2 million with the addition of Leslie coming in for her $1 million, now $3 million. And now my 704, this is my 704B, correct? What's my 704C? How much cash do I have?
$2 million.
$2 million. What's the basis in the equipment?
0.
0. $2 million. Oops. 0 liabilities, $500K, $500K, $1 million, $2 million. Now, do I have a short-term asset that I have to contend with? Do I have a long-term asset that I have to contend with? Do I have a depreciable asset that I have to contend with? Depreciation. So, if we divide the depreciation up into 5 years, it's $200,000, correct? 30% or 33% of 100,000 or 200,000 is 66,000, correct? Leslie's owed 66,000 of depreciation. Pete and Jeff, the inherent gain partners, are also owed 66 if we have enough to support it. But we have no tax depreciation whatsoever. Do we not? So now we're in the conundrum of, is it traditional with curative, or remedial? Okay? So the point I'm trying to make is the issuance of units, the admission of a new partner, or the issuance of units, however we want to say it, that sets fair value is a revaluation event which causes a new 704 calculation to be done. Burton, how often does this happen?
Why do you call it reversed?
Reverse? Because we had the person who came to the partnership
Yeah.
contributed cash.
Oh.
Okay, and the existing partners are the ones that are sitting on inherent gain. So 704C is everybody's contributing. Reverse 704C is when you have a new partner contributing, and it could be an inherent gain asset. Now, where this really gets nauseating and gets difficult is Leslie has a piece of equipment that has a fair value of $1 million, acquisition cost of $1 million, and a cum of $1 million, so net book value of 0, right? Pete has a machine exactly like Leslie's, fair value of $1 million, acquisition cost of $1 million, but net book or a cum of $200,000. Stuthman puts in $1 million. So Stuthman's capital fair value, capital account, and tax basis is $1 million. Leslie's fair value is $1 million and 0. Pete's is $1,800,000. Well, Pete has an inherent gain built in there. Leslie has an inherent gain in there. It's not proportional. And trying to figure out how to drive that special allocation of depreciation to equalize her out when she has a larger inherent gain and Pete has a smaller inherent gain is mind-numbing. Okay, so this is where I say there's New York law and there's California law, and then there's what we do in Nebraska. And what I mean by that, and I'm going to pull this up. Let's see, what's this? Who's this? Oh, all right. I can't see. And this is the methodology that we use, or I use, to bring sanity into this. What did I hit? So I got a formula here. Let's see. That says, okay, I got a beginning point of -20. I got a beginning point of 117. And I got a beginning point of 202. And I have inherent gains that are varied the same way I just described. I know that my 704B ending point is 14 million bucks. I know that's my target. I now have something to aim at. And I know my ending capital account is 242. I have something to aim at. And I know that I have these short-term items and these long-term items that are knowns. So, what amount is required? Well, that's interesting. Oh. I know that once I have that, what has to be pushed to that particular partner to add up to that number? So I use their ending capital account. I know based on 704B what the ending capital account should be because I've taken my fair value depreciation and I've allocated that to them. Now I have a target to aim at. I use that target to arrive at these special allocations at in the middle. I back into it. I don't magically say, well, she's got $1 million, I got 200. I say, what should happen in the middle to make this true? Because if you try to focus in on the disproportionality of the inherent gain that's embedded in that asset, you will be beating your head against the wall. It's almost, for me, it's a virtual impossibility. So I use the ending capital, fair value capital count as a target and pick that up and bring it over to say that's going to be my ending tax 704 capital. I know my short term that's going to trigger, I know my long term that's going to trigger, and I know in this case I'm taking something over 10 years. So I take my beginning plus the short term plus the long term, which says I get to 298,000. And I know that my target is 14,947. And I know that I have 10 years that I'm going to run that out over. So I take the difference between the 14,947 and the 298, I divide it by 10, and I jam that income to them. That's how I do it. That's how I deal with the disproportionality of inherent gains that exist. Does that seem slightly clear to everybody?
Are you doing inherent losses in the afternoon, Pete?
No. I'm not touching losses. I don't know what to do with losses, honestly.
Well, everything always has gain in it, so that's fine.
Every Let's client, they're successful ventures for sure. Okay.
So in this last example you did with Leslie,
Yeah,
that's saying if the 5 years ran out from the original start of the partnership.
yeah.
What if you were in year 3?
It'd be a revaluation event.
You don't worry about running out the old, you just start completely fresh and say, what do we have to do for another 5 years?
Okay, so I'm going to go back to a comment I made before, Brett. There's California law, there's New York law, and then there's what I do here in the Midwest. The question you're asking is, do we have to respect and keep tabs on that original 704 calculation? And under the rules and regulations, the answer to that is yes, you do. Ask me if I do.
Do you?
I don't. I treat this as a whole new revaluation event, as if we shoved everything into a bucket together, and then I go back to that same procedure of saying, what's my tax basis capital account? It's brand new beginning tax basis capital account. I know what my target is. I know my short term. I know my long term. I know the variance between those two, and I know the amount I'm going to run it out over that schedule of 10 years. So I'm going to, and that's what Joe was saying is, we're not going to respect those multi-layered 704C allocations because it's hard enough, and this is close enough. And if somebody wants to bust us for the shortcut, have at it. Do the calculation and tell us what you think it is, because this is close enough.
That was Joe's comment yesterday, why he does that, because it turns a tax return into a $70,000 tax return.
Yes, 100%.